In this video, traders, I want to talk a little bit about forward testing versus back testing. Stay tuned. Hey guys, warm welcome to you. Thank you so much for joining me. All right, so I don't claim to be an expert on this at all. I don't claim to be an expert in algorithmic trading. I'm approaching this from a discretionary trader's perspective. I've actually got a guest coming off my podcast who is an expert, ex-hedge fund guy, does algorithmic trading exclusively. So people like that are far more in tune with this type of backtesting thing. I'm approaching from a discretionary trader's perspective, and sometimes I think that is useful, right? I mean, I do dabble now and then. I work with developers to write little pieces of code that help align me with certain conditions. And I have another piece of code that's like a VWAP algorithm. And guys are in there kind of looking at that and working with that. But I'm just doing it for fun. I'm just doing it because I like doing anything to do with trading. I like exploring something that I'm not so good at in a new area. And who knows, you know, maybe these play a little bit of a part and allocate a bit of capital to these as they become kind of something reasonable. I don't know. But anyway, what's interesting actually, if you're a pure discretionary trader, having to work out exactly your decision process in the heat of the moment is really quite good, because you've got your filters, you've got your triggers, and then you go, why would I do this? Why would I do that? And you kind of have to then say to the developer, hey, this is what I do. So how do we kind of look for that? Can we kind of summarize that with some kind of tool? Can we summarize that by looking at volume? Or this, you know, it's an interesting kind of angle to go down, a routine to go through. So anyway, going off topic, what I'm going to talk about is this back testing versus forward testing. So back testing is interesting, right? And when you dig into it, you can literally make anything look really, really good when you've got history on your side. You can have a superb system when you've got history on your side. You can say, hey, actually, you know what? In massive bull runs, I just want to buy every X% dip. There you go, there's a super profitable strategy. But of course, it completely dies a death when that dip just gets lower and lower and lower, and it turns into a stagnating or bear market. You lose all your gains. And so the difference is or the challenge becomes, how do you adjust for market regimes? And you might then say, well, look, when we changed from bull to bear, it was obvious because we took out this low and we tagged through this moving average, and you just add that in and it looks great. But then, you know, does that repeat itself? So it's very easy in backtesting to curve fit your strategy. It's very easy to say, hey, I know the history, I'm going to do this, and I think that'll work. And I think that, you know, your results can look amazing, you know, and something that I've kind of done out of curiosity with this developer is like, okay, you know, what if we did this? And like, oh, it looks really great. And then you kind of look at it and go, oh yeah, but that really is just looking and trying to curve fit it to the data that's presented. And everyone who knows, you guys are into algorithmic trading, know that's a big no-no. Curve fitting is a big no-no, and you can fall into that trap quite easily. And so backtesting, you've got to be, you know, the way that I like to look at this is go, okay, I've got an idea and a strategy. This is how I would do it. Forget about history, but as much as you can, obviously being a trader, sitting in front of the screen, you still know what's happened in your mind, and then you test it. And you see what the results are like, and you try not to try and add little things to fine tune it. So then you've got a situation, then you've got something that's reasonably robust. And by the way, it doesn't have to be from an algorithmic perspective. This can be just from a pure trading strategy perspective. You can have this strategy, use some sort of backtest functionality with the basic rules, and then go, hey, I want to trade this moving forward. I'm going to trade it manually. I'm not going to automate it anyway, but I now want to see how effective that is moving forward. That's when you move into the forward testing phase. So you're back testing your rules, you go back and run it over how many years or any months, whatever you want to do. Forward testing is go, hey, I've got the rules now, let me execute those correctly and properly as I move through the days and weeks and months and even years. And actually one of these things that I wrote it, I helped with a developer, did all the good stuff. I just asked him and told him kind of how to work with that. I've been forward testing it for almost a year. So I've been actually seeing how the trades are executed live, seeing how they operate, seeing what the drawdown is, and seeing how they match up with the back-tested results. Because forward testing is basically you sticking to the rules and then just executing. And the thing is, if there's a massive discrepancy between the two, it's a bit of an alarm bell, because you might have curve fitted, the regime might be different, but if the kind of if the results are similar, then you can say, actually, maybe there is some merit to that back testing. Maybe this has got some merit. And yes, we never know what performance is going to be like, never know how the regime is going to change. We just don't know what's going to happen. I mean, right now I'm talking, it's completely different. I've got an inflation-based environment with interest rates going up. We've not had that for ages. How does that affect the way the market oscillates, or the market you're specifically trying to trade oscillates? We've had, you know, pound making huge moves, yen making huge moves, dollar making huge moves. So the regime can change, so not guaranteed, but what it does is when you do back testing and then you kind of forward test stuff, and as a discretionary trader, if you're a discretionary trader watching this, that's you just going execute, execute, execute when I see those signals and just building data. Doesn't mean going live straight away with it, it means building data. Now, some of you are going to say, well, can I just go live with it? And yeah, maybe you can. If you're prepared to allocate a small amount of capital to that, then I think, why not? You know, as long as you're risk managed, and as long as you understand all the consequences, which I know you do, then I think allocating a small amount of capital isn't such a bad idea. So where danger of curve fitting, you don't know how the strategy is going to be in the real world. Forward testing can be done manually. I think that's the main point here. It's not an algorithmic video. This is, hey, you can still do this type of stuff if you're a discretionary trader, as long as you have certain rules. Now, the issue is with discretionary traders, many of us have kind of rules up to a certain point. I've got a triggers, a filters and trigger system, and then there's a discretionary element, right? And that's the bit that's tricky sometimes to kind of back test, obviously, and forward test. So it's almost the 80-20 rule of saying, okay, if I had these rules and executed this perfectly, what would the results be in history? If I had these rules and executed perfectly, what are the results now, next day, next day, next day, next day? And then from a discretionary element, is there room for discretion there? If I can get good at spotting something like some weakness or strength or this, that, the other, will that improve returns? And that's a skill you can potentially work on. So how do the rules perform live? Difference in results, going to say how we talked about how robust the system is. You don't want something that's got really great back testing, then as soon as you start operating it, forward testing it 6 months down the line, the results are completely different, then it's pointless. And that's probably because you've curve fitted too much. All right, so forward testing versus back testing, those are my thoughts on it. Algo guys watching this, correct me as much as you like in the comment section below. Like I say, I'm a discretionary guy. I always have been. I like to kind of have a little bit of fun and work with people to play around with. I think it's super interesting. But hey, you know what? I think there's opportunity to explore both. Do you become hybrid rather than pure algo? Do you become, can you add a little bit of help for your discretionary trading? Like maybe the trade gets you, algo gets you into the trade and then you manage the trade, or maybe you get into the trade yourself and then an algo manages the trade. There's so many options. You don't have to kind of put your flag in one camp and go, that's exactly who I am. Obviously, I think diving around from one to the other is probably not good because you never hone your craft. It's different skill sets. But you know, if you want to kind of adjust and adapt and add a little bit of an algo flavor to your discretionary trading, then yeah, maybe this is useful for you. Take care. See you next one. Bye-bye.